Hello and welcome to our FOMC meeting analysis. I'm Andrew Paolillo, Director of Member Lending and Strategies here at the Federal Home Loan Bank of Boston. As widely expected, the Federal Open Market Committee voted to leave the federal funds target range unchanged, maintaining the target range at 350 to 375. The biggest takeaway from today's meeting is that the Federal Reserve remains firmly in a wait-and-see mode. The committee continues to describe economic activity as expanding at a solid pace, led by continued exceptional growth in business spending and capital expenditures, largely due to AI infrastructure investment. Labor market conditions were characterized as strong and stable. Much more focus was placed on inflation, which remains above the Fed's 2% objective, and policymakers made clear that they are not yet confident that inflation is moving sustainably back to target. While today's statement changed very little from the June meeting, one notable development was the level of disagreement within the committee. 3 voting members dissented in favor of a 25 basis point rate increase. Chair Walsh characterized it as a good family fight, noting that the healthy discussion in assessing the appropriate monetary policy that focuses on long-term trends and data, not necessarily any one data point, a reference to a softer June CPI print. Consistent with his first meeting, Chair Walsh did not provide forward guidance and re-emphasized the goal of allowing the markets to react to the economy and not simply react to what they think the Fed will do. Playing the ball, not the referee, as he noted. He mentioned that multiple times that the bond markets have pushed both nominal and real interest rates higher over the last 42 days since the last FOMC announcement, a development that they will continue to monitor and encourage natural price discovery in the markets. Chair Walsh also returned repeatedly to inflation throughout the press conference. He noted a lot of discussion related to identifying underlying inflation amidst the shocks to the supply side, such as with energy markets while tensions in the Middle East continue to ebb and flow. Chair Walsh also mentioned that they feel that they have a good handle on aggregate demand for goods and services in the economy, and identifying aggregate supply involves more inference. So what does all this today mean for Federal Home Loan Bank of Boston members? The message largely remains unchanged. Immediately following the press conference, short-term yields moved lower as some of the hawkish sentiments that had made their way into fixed income markets and priced into the yield curve have begun to dissipate. The level and shape of the yield curve may continue to make cost-efficient deposit gathering and retention challenging. However, it also makes the economics of putting cash to work more appealing. Most points in the yield curve are at or still very near 2026 highs. So whether it is in the form of loans benefiting from strength in the national, regional, and local economies, or opportunities to supplement in the investment portfolio, the sustained high level of interest rates creates the backdrop to accelerate the repricing of the asset side of the balance sheet. Rate hikes continue to remain priced into the yield curve, but to a slightly reduced magnitude versus immediately before the meeting. We will continue to monitor the shifting economic and market conditions and the potential impacts for Federal Home Loan Bank of Boston members. Thank you very much for watching.